Welcome back to Lamb's Cryptoverse. Today we're going to discuss the PPI, the Producer Price Index, which is produced by the Bureau of Labor Statistics. Everyone went nuts over this report, and they went nuts over the CPI report that came out. And they went nuts over the labor report, meaning stocks sold off sharply. So why is everyone so surprised about the inflation news? Well, it's still rising higher than expected. And I'm going to get my notes out and just go over a few things, and then we're going to interpret it. First of all, June's number was up 1.1% on a monthly basis. That's even higher than the previous month. And on a rolling 12-month basis, PPI was up 11.3%. So this too is higher than expected. This is why the market's really worried. But if you look into the numbers, we can see a few things. I'm going to go to the next tab here. Well, first of all, you can see the 11.3% number I just mentioned. But then, if you take out food and energy, you could see that it's topping out. So that's a good sign that there already is some kind of peak inflation. The other point I want to mention, and no one's talking about, and you don't even see it here, is that we had a huge increase in PPI, but at the same time, the CRP index is plummeting and energy prices are plummeting. And I'm going to show you a chart. You could pull up many different charts. This one here is on Invesco's DB Commodity Index. It's similar to the other indices like the Bloomberg Commodity Index. And you could see it topped out in June. So even though, and here's where it gets strange, even though the PPI number was really strong and really high for June, if you look at June's number, we topped out on around June 9th, June 8th, June 9th, we topped out on the commodity index. And we plunged, and we're still plunging as of July 14th. But you're not seeing this data reflect in the PPI. Most people think, oh, it doesn't get reflected in the CPI. But it also doesn't get reflected in the PPI numbers too. It takes time. And just going back to this number here, most of this increase came from energy prices. And if you dig down, it's from gasoline. So going back to this chart here, there's a delay from here to here, from this peak of the commodity index down to where we are now. There's a delay for many reasons. One reason is inventories, right? You've got different inventory methods. You've got timing of those inventories from when you buy the the gasoline until when you sell to your customers. So what's this affecting the market? How is this affecting the Fed funds rate futures and expectations for rate hikes? Well, if you go here to probabilities, well, actually a better one is this. This is the target rate probabilities. It's a bar chart. I like to use this one. It's shown that there's nearly a 55% chance of a 75 basis point increase in the federal funds rate at its next meeting. And that's around July 26th, 27th. And there's a 45% chance of a 100 basis point increase. So this is crazy because instead of front loading the federal fund rate increase, the Fed's actually doing the opposite. You remember the Fed was too dovish, and then they started increasing rates slowly, and now they're almost accelerating the rate increases, right? They went from a 50 basis point rate increase to 75 basis points, and now people are talking about a 100 basis point rate increase. That shows you the Fed has lost all credibility. So let's go to the yield curve. Actually, I have an Excel spreadsheet I did here. This spreadsheet, and this chart of the spreadsheet shows you the yield curve going from right to left starting from the 1 month T-bill, from the T-bills basically, all the way up to the 2-year, and then the 7-year and the 30-year. And as you can see, and I've got my mouse here, you can see the 1-year T-bill is at 3.247, and the 2-year note is at 3.1. And the 2-year note versus the 10-year note, and I've got these highlighted, these two, maybe I should make them in red. These two right here, 3.1 versus 2.957 for the 10-year. That's the benchmark that's used for the inversion of the yield curve when people talk about it being inverted. But before we go there, I'm going to show you one or two things. Number one, the yield curve's still pretty flat. And if you go to the long end, right here, 3.11%, that's for the 30-year bond. So the 30-year bond and even a 10-year note, still, you can't see it here, but they still seem high. You could see here that the 30-year bond just looks too high. The rate looks too high. But if you go to other types of charts, like if you compare the 10-year note or even the 30-year bond to the ISM index, those yields look too high versus the ISM Purchasing Managers Index. And now let's go to the actually 10-2 as everyone talks about. This is a 10-year note versus the 2-year note, a 10-year bond versus a 2-year bond. And you could see we've gone negative here. We're at minus 22 basis points as of yesterday. As of today, we're around minus 15 or so basis points. And you can see the last time it happened was before the recession of 2008. And we can go back here, all the way back. Let's go back to 1980. And you can see that it's pretty accurate. It has a very long lead, right? And you could see it touched negative point on February 2006. That was way before the 2008 recession. And you could see it also led early in 2000 when tech stocks were topping out. And it worked. It led and worked way back in around for the 1990s recession. Now, going back to what everyone talks about, the 1970s, it's a little more difficult. It went down sharply. It didn't just touch a few basis points negative. It went down to minus 2%. And that's because of the Volcker years when Volcker increased rates substantially. So this is pretty interesting. This is shown, according to history, if it repeats itself, that there's going to be a recession sometime in the future. The question is when. And I think it's going to be sooner than later because you can't see it here. What you're seeing here is the spread. But what you're not seeing is global liquidity. Global liquidity is coming down even stronger and quicker than you're seeing here in the yield curve. So there you have it. I think I covered all my bases here. Yeah, I just want to tie it all together. So you've had the labor report and you've had the CPI and the PPI all saying that the Fed needs to tighten rates at a quicker rate. And as a result, stock prices are crashing or declining rapidly. And the yield curve is turning more and more inverted. So only time will tell when there's going to be a recession. But I think one thing we know for sure is that a recession is coming. And I personally think it's going to come sooner than later, maybe within a few months. And there's also a technical recession. And we saw that last quarter. I think that was for the March quarter. And we might see that for the June quarter. The reason I'm saying technical, because the March GDP, even though it was negative, it wasn't that negative. And a lot of that negativity had to do with inventories. And that's another issue. I think the recession is going to be short and quick. It's going to be pretty steep, I should say. And the reason is because we have inventory building. We're going to talk about that later in a later video. But we have inventories going like this, and there's a lot of double ordering. And you've seen that in different industries. We all saw the news from Walmart and Target and Bed Bath & Beyond that there is screwed up the inventories. So there's a lot of inventory building. And what that means is it's going to affect the GDP. It's also going to affect pricing, because think about it. What do you do if you want to get rid of your excess inventories? You slash prices, right? And one other thing is semiconductors. Everyone is talking about the shortage of chips. Well, guess what? You could double and triple order from chip companies. Like let's say you're a car company like General Motors. They have 97,000 cars, something like that, that have not been put to the dealerships because they're missing semiconductors. GM and other car companies could double and triple order those same chips. So if they need chips for 100,000 cars, they can order chips for 300,000 cars, and then they could cancel those orders. So when they do that order canceling, that's going to cause a sharp decline in inventories, which is going to affect the GDP. So we have a lot going on here, a lot of wheels in motion. Thank you all for listening, and please hit the like button, and welcome back, and come again, I should say, to Lamb's Crypto.